Are you in your 20s and just starting out your property journey? Maybe you're in your 40s and hitting your peak earning years, or in your 50s and wondering how to secure your financial future. Look, no matter where you are in life, your property investment strategy needs to evolve with you. I've found that too many investors treat property as a one-size-fits-all game, and that's why half of the investors sell up in the first 5 years. They get things wrong. But in today's episode of the Michael Yardney podcast, I'm joined by Brett Warren, National Director of Property at Metropole. And we're going to talk about how to invest wisely at every age and every stage in your life and your property journey. But we're also going to discuss some of the timeless fundamentals that apply no matter where you are at your journey. So whether you're starting out or consolidating for retirement, today's conversation will help you plan smarter and avoid mistakes that most investors make. So let's get on with the show.
Welcome to the Michael Yardney podcast, where twice each week you will learn a number of new ideas regarding success, property investment and money in around 30 minutes. Our show is brought to you by Metropole, who specialise in helping you grow, protect and pass on your wealth through strategic property and wealth advice. Now here's your host, Michael Yardney, Australia's authority in wealth creation through property, who has been voted one of Australia's top 50 most influential thought leaders.
Hi, Brett. Welcome back to our weekly session.
Michael, good to be with you as always.
Now, you and I often talk about how property investment is simple but not easy. But what really struck me about an article that you wrote recently in Property Update, I'm going to leave a link to it in the show notes, is that you explained how strategy needs to evolve at different stages of your life.
Yeah, that's right. I think the big mistake a lot of investors make is treating property like a transaction, a one-off event. But in reality, it's a real long-term journey. You know, the fundamentals don't change, but how you apply them depends very much on your age, the stage of life you're at, and also your goals.
Okay, so we've often said property investment is simple but not easy. What are the core fundamentals that apply to every investor? Look, no matter what age. And then I would like to drill down and get your thoughts on what different people who are watching this, listening to this should be doing at their age. And it's not just age, Brett, I guess it's also the stage of their journey. But let's start with the fundamentals.
Yeah, look, I think no matter what age you're at, if you're starting to look at investing, the first thing you need to do is educate yourself. You've got to have some form of, financial literacy, and it's really non-negotiable understanding those types of things, particularly in the space you're at. So a great start, Michael, is listening to the podcasts and reading the books and the blogs and things like that as well. The next step I would argue is having the right team. I often hear you say, if you're the smartest person in your team, you're going to be in trouble. So having the right strategist, someone who's had decades of experience, not just a couple of years. I think we like to say someone who's been there and done that. And in your case, Michael wrote 9 books. Having that philosophy is important. Having a broker, a finance strategist is even better, an accountant, and also a buyer's agent that has that on-the-ground perspective. I think having that team is really important. Always starting with a plan. I think, as I said before, a lot of people
If I could interrupt for a sec, Brett, I agree with you with the concept of a team, but I think one of the things a lot of people leave out, or one of the people in the team, is the strategist, because the mortgage broker is going to advise you about the best finance. But finance for what? You don't know what you want at this point. An accountant will tell you about the right structures, and a buyer's agent will implement a strategy, but you you do need somebody overarching to become the project manager of your journey and put a plan together for you.
That's right. And be very, very careful of mortgage brokers who are giving property advice and, property people who are giving mortgage advice. I think you've got to have a specialist in each area and each location. They're very good at what they do rather than a jack of all trades, I guess. And touching on your point,
Some
Michael,
people say we're biased because we are property strategists and we are buyer's agents. And the answer is we are. But we've built a successful business helping thousands of people over multiple decades because we've fine-tuned it. So we started off as buyer's agents in the early 2000s. I was one of the first ones in Melbourne when there was only 3 or 4 people doing that. But over time, our offering has matured to be able to give people strategic property and wealth advice at Metropole, not just a buyer's agent. So while all these people are important, I think the strategy has to come first, Brett.
Yeah, and I think the reason it's so important is because a strategist will give you that long-term focus. They'll understand what it is you want to achieve over the longer term. They're not going to let you get distracted by hotspots and making $50,000 by Christmas. They're chartering a course for you and planning that course for you. So it always starts with a plan. And it's always about long-term capital growth. It's always about compounding and leveraging, never really about cash flow. Cash flow is an important element, but it's the icing on the cake. So getting that capital growth right. And I think the other thing that people understand, touching on that financial literacy again, is actually having a buffer and understanding that there are going to be cycles and being prepared for those cycles, Michael.
Now, at the beginning, I actually mentioned about we're going to discuss the different strategies at different ages. But in the article that you wrote, you actually outlined 4 distinct stages as opposed to ages that you believe every successful property investor goes through. So can you walk us through what those stages are and why it's important to recognize them?
Of course, yeah. Look, very, very important. And the first thing I said before is education. And in the case of property, it's really understanding the cycles. And I think if you're working with someone who's been through multiple cycles, you're going to have a lot more success, and it's actually going to be a calmer journey because there are a lot of peaks and troughs on those cycles in that journey. Also understanding some element of finance and understanding deposits and equity and line of credits and buffers and things like that as well. And most importantly, how to avoid scams, because I guess when you're first starting out and educating yourself, it's a bit hard to kind of sort that out.
Everything looks exciting and shiny.
Yeah. Then the next stage is actually getting into the investment and actually accumulating. And I guess it's the asset growth stage where you're building a portfolio of good capital growth assets where you're creating equity. There's some compounding and leverage and growth over a period of time. And that could be, even a 7 or 10 year period, maybe one property cycle before the next stage is transitioning, reducing that debt, paying down some of the debt, switching to principal and interest, starting to lower down your loan to value ratios, increasing the safety and the buffer in your portfolio. And then finally, as that starts to come down over maybe another cycle, finally you've got that exit stage where you can actually start living off your portfolio. And while we may not know what that looks like, but if you've got a good, strong asset base, it's going to give you some passive income. And then you can talk to someone like a good financial advisor who can bring in your property portfolio, your super, maybe some shares and some savings to make sure you're maximising your outcome. And I guess, look, each stage has a different priority, but all those stepping stones are moving towards that financial freedom, Michael.
Well, it's well known that about half property investors, people who get in property investments, sell up. It used to be said within 5 years. The latest Cotality, which is now CoreLogic, figures show that actually many investors sell up even in 3 years, so they never get past their first property. In fact, 92% don't get past their first or second property. Why does that happen, Brett? How do we avoid that trap? How do people avoid becoming a statistic?
Yeah, look, I think 70% is an interesting one. So I think it's 78% or something like that. I mean, I think a lot of those people probably have the wrong property. Maybe they didn't even buy the property, Michael. Maybe they inherited the property, or it was a home and they moved out and they kept it as investment. Maybe they have bought the wrong property. Maybe they've chased a short-term yield or a cash flow and the market's turned and the hot spot's now a not spot. Maybe their finance isn't structured properly and maybe left them a little bit vulnerable, and there's been a job loss, or a tenant's had to not pay their rent for a month or something like that. So having a buffer is very important, which we'll get to as well. A buffer means you can ride through those times, whether you lose a job or your partner has a child or something like that. You can get through those periods without having to sell assets. And I guess the big one, Michael, is that long-term plan we talk about. Rather than treating it as a transaction, it's a long-term process. It's a building process and getting to that long-term goal that you're looking for. I guess you want to avoid all of those traps by focusing on quality assets, getting good, solid financial structures in place and buffers, and overall having a strategy and someone to guide you through that path.
Now, at the beginning of the show, in the introduction, I promised our listeners and viewers that we're going to break it down for each age group, and we will. But I think it is important, so please stay with us, but I believe it's important to have some of these big picture concepts that apply at whatever stage you are, and then we will get into the detail. But in the article, you also shared some strong contrarian views, some myths, some things that people get wrong. Could you maybe expand on that a little?
Yeah. So look, I mean, the first one is obviously capital growth versus cash flow. And in my opinion, obviously capital growth has to be the priority. It's going to build equity. It's going to keep you in the game longer. It's going to allow you to grow your asset base faster, because building cash flow, you're going to get taxed. There's going to be money that comes out of that. So you don't quite get the leverage. And it's cash flow that keeps you in the game, don't get me wrong, and that's a very important thing. But it's capital growth that's going to get you out of the rat race. And it's going to be that compound and growth and leverage over time that's going to be very important.
Sure.
The next thing is again, we always hear location, but focusing on the right location and getting that right, rather than thinking, I've got to get a house because it's got land and I'll go and buy in the middle of nowhere just because it's got a block of land, when in all reality, if you had focused on that location and gotten that right, we believe location does 80% of the heavy lifting for capital growth. So that's going to be incredibly important. The next one's timing the market. When you're looking at multiple property cycles, it is quite forgiving. So whether you buy at the beginning of a cycle or midway at the end, it's not as important because you're going to hold that longer term. Success actually comes from time in the market and holding over those decades and those cycles to take advantage of those growths and that compound and the leverage as well. The next one is, I guess, people get a bit of analysis paralysis, don't they, Michael? They follow the data. They just look at the stats and follow that herd mentality, which is not what we want. And finally, something that's very hard.
If I could interrupt for a sec, Brett, there's even a new wave on this following the data because of AI.
Yeah.
So there are a number of new programs out, people wanting you to get in, working with them because they've got new AI programs to look at the data. We actually did a show not that long ago. So if people don't currently subscribe to this podcast, wherever you're watching or viewing this, listening to this, please subscribe so you get Brett and my information every session, but also go back to a previous show about artificial intelligence and the importance of it, because I believe at the moment, artificial intelligence, AI, whatever programs you're talking about, looking in the rear vision mirror at all the current data, and that's allowing some companies to herd all their clients into the same locations, and they're all using much the same data, Brett, pushing property values in some regional and smaller areas way beyond the fundamentals.
Yeah, which is a concern. You've got to have that perspective. It's a balance of art and science.
So we use AI, we use research, we do the research of the data, but what's missing is the perspective. So we've often said property investment is part science and part art. The art is understanding how to interpret the data and why one side of the street is better than the other, or one end of the suburb is different to the other. And again, it all starts with the strategy. So when you use the team at Metropole as part of your property journey, yes, you're going to have access to the data. We pay a lot of money for the research data, but then we spend a lot of time, and you and I regularly get together with the team and look at what it means as opposed to just spitting out raw data.
Yeah, most definitely. I guess the last thing, Michael, is that wealth is really a reward for delayed gratification. It's something that's quite difficult these days because everything's at the tip of your finger on your phone. So, that compounding works over decades. So don't interrupt it. Let it do its thing. And, I guess that's part of that long-term plan and charting a course and just sticking to it.
Yeah, well, let's get into some age-specific strategies. And at Metropole, we help a lot of high net worth clients, but we also help home buyers, and we also help people getting into the property market. Now, I find it really impressive and very pleased when first-time investors actually approach us, because they know that we don't rush off and buy something straight away. We start with a strategy, and to be blunt, that does come as a cost. And while some beginning investors would see that as a cost, those of our clients who've succeeded have actually seen it as an investment. So what are some of the things that, I'm in my mid-20s, I'm in my 30s listening to you at the moment, Brett, what should my focus be?
Yeah, look, and I took some of these points from what I did when I kind of first started, and we talked a little about education to start with, but then when the time came, I guess what I didn't realize at that age, and what I try to impress upon people I'm talking to at this age, is they've actually got one of the biggest assets that nobody else has got, right, Michael? Time. They've got, maybe 30 odd years to retirement, and that could be up to 3 property cycles. So that compounding can be extremely valuable with time. That's the main thing to understand. If you can get that right property right, it can really set you up moving forward. But there's also some challenges, and I guess the main hurdle is saving a deposit. I guess there's parental guarantees and teaming up with family and things like that as well that can help. But my advice there would probably be to stay at home as long as you can, and I guess save as much as you can as well.
Yes.
You're going to have to work, and there's so many competing interests at that age when you're learning about cars and the opposite sex and going out and having dinner and dates and all the rest. So you've got to be quite disciplined as well. The other thing is consider rentvesting. Sometimes, you can rent where you want and invest where you can afford. And a good thing at the moment, Michael, is that first home buyer grant. I think that's a massive opportunity. When I first invested, I actually bought a property that I lived in. It was a home. I took the home buyer grants, but I knew in the back of my mind that it wasn't my home. It wasn't my forever home. I was going to live there for a year or two, but it allowed me to get into the market with a 5% deposit. I didn't have to have much help from my parents and things like that as well. So taking advantage of those things can be really, really helpful on those kinds of grants and in getting into that kind of market. But I also made sure I focused on long-term growth and long-term fundamentals rather than just chasing quick cash flow and quick dollars and things like that as well. And I guess the biggest thing along that journey in my younger years was having someone there to guide me through my money habits with budgeting and saving, and being consistent with my investments and saving, and being disciplined with my pots of money and my habits and things like that as well.
So I guess the bottom line for those who are starting off is time is on your side. Don't be in a rush, and get a good team around you. Okay, let's move to the next group of people who could well be in their 30s or 40s. Some of them have got families, some are starting families, they're juggling their careers. They may already have a home, like you said, because they listened to the advice you you just said 5, 10 years ago, but now they're actually wanting to build their wealth. How do they start getting momentum there? What's the next stage?
Yeah, this is a tough one because now you're starting to juggle careers and mortgages, and maybe you're starting to have kids and things as well. So it is quite a difficult one. For people who are not at that stage yet, my advice would be to try and get some runs on the board early, because the time of kids and family and new babies and stuff, it's a bit of a fog, Michael, isn't it? For probably
Yes.
anywhere from 3 to 5 years. So you kind of go into that brain fog. So my advice is to try and get in, if you can, a little bit early and get some runs on the board. But at that particular time, you're like earning a bit more, so you can leverage a bit more equity, maybe from your home as well. But you've got to be strategic. So, no more buying emotionally or close to home. You've got to be geographically agnostic. So look nationally, look at the big capitals, the investment grade suburbs. Probably good opportunities to diversify if you've got a property or two in one location, to start to understand that. And also starts to look at add value potential as well. So if you do have a couple of properties, maybe somewhere where you can add a small renovation or a subdivision or even a development, which is some of the clients we help. And sometimes land banking through that period. So buying a good property with some development potential and then land banking through that period is also a really good strategy. And I guess the difficult thing at that age also is you kind of want to get things right, because you've got more responsibilities with family and things as well. So avoid that analysis paralysis. It's more about time in the market and not perfecting the timing. And at the 30s and 40s, you've still got 2 decades and 2 property cycles to get it right. So there's still going to be enough time there.
Now, interestingly, you talked about land banking. If I could just explain the concept of buying the worst house in the best street and just allowing the market to move is a very old-fashioned, tried and true investment strategy. So if you want to get to the next level, but not ready to do a development because you don't have the knowledge, well, we can help you with that at Metropole. We don't have the finance. Buying a property that's rentable, that's going to work well, but that doesn't, you can pull down in the future and do a development, is something that we specialize in at Metropole. And we can help you become what we call an armchair developer and run the whole process from concept to completion. In other words, doing a feasibility on the property before you buy it, and then getting a development approval while you have a tenant in place. And then a year or two later, if you choose to, if the finances are right, if the timing is right, to actually pull down the old house and build 2 townhouses or duplex or whatever, and then keep them as long-term investment. So, Brett, we're not suggesting development as a form of cash flow. We're talking about development of buying your investment wholesale.
Correct. Yeah. And look, speaking of family, I mean, those are amazing, amazing types of properties to pass on to the next generation as well, aren't they? So, yeah, absolutely.
Very much so. Okay, let's get to the next age bracket, people in their 40s and 50s. Sometimes the kids have left home if they're in their 50s, I guess. This is often the people's peak earning stage. What strategies should these investors prioritize?
Yeah, look, this is probably the best years and the golden years, and probably not the last opportunity, but you've got the ability to get it right here and will do exceptionally well. You're going to have a higher income, probably going to have some equity in your home and things like that as well. You're going to have superannuation contributions, and that may be something you could actually look into, because I know myself, I've leveraged and I was able to get a higher asset and a higher return and a higher reward for my super. So that may be something you want to consider as well. But you can use that equity now. It's not like when you're in your 20s and you've got to chase and scrimp and save and things like that as well. You've got equity not only to invest in properties, but also to have as buffers and to maybe fund some of your projects and fund some of your property business in your portfolio as well. And this is probably the best time to start diversifying into shares and ETFs and different kinds of funds as well. I often found in my 20s and 30s, property was the best asset because I could leverage, I could add the value. But now I'm in my 40s and I've got that asset base. I can start to boost and look at different areas in shares and ETFs and things like that as well. And I guess the last thing, Michael, is you kind of feel like you've got through that brain fog with kids and family. You're getting a pay rise and you're doing quite well. And you probably can get a little bit complacent. You're going to get
Yeah.
comfortable as well, and maybe look at buying a car or updating a home or something like that as well. But probably resist that urge and put your money to work for you, because I know your future self will thank you for it.
This is a time a lot of clients come to Metropole because they recognize they've got a 10, 15-year window. Many people want to stop working by 60, others before that. So they don't really know, am I going to achieve it, or what do I need to do to be able to achieve it? And that's where our wealth planners, wealth strategists do their magic with the powerful software that we help our clients with by doing a whole lot of what ifs. We put in where you are now, what you want to achieve, what amount of cash flow you want. Do you own properties in your own name, in trusts, in your super fund? Where are they? What's happening? And then we tell you, are you going to achieve that? Are you going to get to where you want to get to? Or what do you have to do, and especially what you should not do, to make sure that you get there? So if you're wondering, are my goals realistic? Am I heading in the right direction? What else should I or could I be doing? Then why not have a chat with the wealth strategist at Metropole? I'll leave a link in the show notes. Initially, it's an obligation-free discussion. We'll explain to you what we can do. Look, you've probably been listening to this podcast, listening to Brett and me, for watching the videos for a long time. And I know, Brett, there are a lot of people out there knowing, oh, I really should be speaking to these people. So why not just do it? Click the link. Well, actually, there isn't a link on this. There will be in the show notes, or just go to Metropole and have a chat, because we're at this early stage of the next phase of the property cycle, where there's all the fundamentals falling into place. Brett and I have discussed this with you every week. For new listeners, it's falling interest rates, increasing confidence, first homeowner grants fueling the market, a lack of supply, and that all is showing that we're now at a period of moderate but prolonged growth. Not all areas are going to perform as well. So go to metropole.com.au and have a look and see, are you heading in the right track, on the right track? Are your strategies going to get you where you want to get to? Because that's the first step, even before we talk about what you do next, Brett.
Yeah, that's right. That's right. Exactly right. And I think it's important understanding those long-term goals and working within these kind of points, and getting a great outcome for that reward.
Okay, next people then, in your 50s, you've got retirement or slowing down around the corner. How would your strategy shift once people are reaching or approaching the retirement stage? Now, retirement's an old-fashioned concept. Not everybody totally leaves the workforce, but it's about having the options and choices.
Yeah, look, I guess the first thing to say, Michael, look, don't rule yourself out. If you're not investing, you haven't invested yet in your 50s, don't rule yourself out at all, because, well, there's some good news and some bad news, right? The good news is you've got time. You've got a full cycle to probably get ahead of where you would be if you did do nothing. The bad
Yes.
news is you just can't afford to get it wrong. So, I
Yes.
guess having someone there is going to be critical. So if you're in that phase, don't be afraid to reach out. And like you said, Michael, I mean, you may not pull the pin and retire at 65 or 67. You may work a bit longer and have that portfolio work for you longer. You may have a good super balance that can do that as well. So don't rule that out. But look, generally by that stage, you should have your asset base, I guess, complete in the accumulation stage. So now it's about shifting from growth and start consolidating, start to pay down debt. If you've got a few underperforming assets that can reduce that debt as you're heading towards retirement, it's probably a time to do that. And then focus on reliable income, rents. Talk to your advisor about your self-managed super fund strategies. Is it worth using your super fund to pay down some more debt, or can you live off that for a period of time and keep investing and understanding the implications of that? And also think about estate planning. This is the time where you should be thinking about passing wealth, even though you probably should do it in your 20s and 30s. It becomes more relevant now, because you're going to start thinking about passing it down to the next generation, and how you do that by maximizing the efficiency and minimizing the taxes and things like that as well. And as I said before, maybe not necessarily stop investing. There may be an opportunity to balance a bit more with some security. Maybe, Michael, we've picked up a good couple of commercial properties for people in their mid-50s recently. So that's a really good option in that area as well, because that'll help with that debt reduction phase.
Well, you've got to remember that if you do retire at 60, you've probably got another 30, 35 years to live. So your property investment shouldn't stop. You actually just have to do things differently, more cautiously. As you said, you can't afford to get it wrong, and balance growth with cash flow. So we've gone through the various age groups. We started off by saying there are some common things they all should be doing. But what are some of the common mistakes you see happen at different stages?
Yeah, look, in the 20s and 30s, Michael, I like to call it shiny object syndrome, right? You're looking
Yeah.
for a quick win and a quick buck. You're chasing a hot spot. You're buying more for cash flow because you're probably on a lower wage, and you're not really planning ahead. I mean, who in their 20s thinks about what they're going to be doing in their 50s? That day will never come around,
No,
but it
no.
often does. Yeah, in the 30s
Quicker
and
than you
40s,
expect, Brett.
yeah, absolutely it
I know
does.
you're not there yet.
Oh, almost. In 30s and 40s, there's a bit more pressure there now because you've got a mortgage, maybe you're starting a family. So there's a bit more analysis. You're a bit more cautious, and you're also a bit more emotional. And you also want to be careful of over leveraging as well. So that's an important phase there. In the 40s and 50s, it is complacency, like we said before, leaving your cash idle, having a lack of diversification to that area. And I also think if you're thinking about it, don't think too long, because by the time you get to 50s, you're losing that compounding and the ability to leverage for another 5 or 10 years if you're waiting too long. And like I said, that's the same thing in the 50s, just waiting too long to consolidate and actually start reducing debt. Some people keep buying properties, but they also take on more debt. So if you've got a plan and you can work out that really nice sweet spot between buying more property and paying down debt, maybe looking at a commercial or more reliable income, then that's going to be important. And also looking at estate planning at that age is important too, Michael.
Sure. So to finish off, Brett, what does success look like for that small percentage of investors who get it right? Now, I say small percentage because we already discussed the statistics. Not that long ago, we did a audit of the results of the clients at Metropole, and we found they're 7.3 times more likely than the average investor to own 6 or more properties. I guess they made the right decisions because they got the right advice. So in our case, and we see that because we manage their properties and property management, we know what assets people have got. And we also follow regularly. We look after our clients by reviewing their portfolio annually, and that doesn't come at any cost to them. It's part of our way of making sure they're heading in the right direction. So we do know what success looks like because you look after these clients, Brett. What does it look like?
Yeah, sure. Look, I mean, at the end of the day, you've got I guess, a substantial asset base that's producing an income. That really just opens up options and gives you choices. And at the end of the day, I think that's what financial freedom is. Having the
Yeah.
ability to choose if you want to work, choose if you want to go on holidays. I often hear people say, oh, gee, I'd love to take an annual trip a year. Well, why not 2 or 3 trips a year? You're not having to rely on the wage or the pension or, I think by the time I get there's going to be no pension, and they're already talking about taxing super. So you've got to have something working alongside you. And I guess those people that do get there, they've created that cash machine that kind of funds their lifestyle. And it's not just about them, is it, Michael? I often hear you talking about legacy and how proud you are of, paying your grandkids' school fees and looking after your future generations, which I'm sure gives you a lot of pride. And I certainly look forward to that as well. But that's it. It's achieving that true financial freedom. Your money's worked hard for you. I'm sure by that time, everyone's worked hard in their life, and they've then got the ability to take it easy and have those choices, which I think is incredibly important.
Thanks, Brett. Look, that was a great overview. And as I said, the idea of this came from a great article you wrote that I'm going to leave to a link in the show notes. But what I love about your message, it combined the timeless principles that we started with the flexibility to adapt as we move through life. Too many people wait for the perfect time, or they copy what somebody else is doing and they end up disappointed. Whether you're listening to this, watching this, whether you're starting in your 20s, building momentum in your 30s, accelerating in your 40s, or consolidating in your 50s, there is a strategy that's going to work for you as long as you've got a plan, as long as you've got a good team around you. But you also need the discipline to stick with quality growth focused assets. So thanks for joining us again today. And if you found this conversation insightful for Brett, please share the show with somebody else who you think would benefit from it. I'm not sure how you found out about the show, but I know a lot of people find out about it from others. There's a share button on whatever podcast app or even YouTube that you're watching this on. Let somebody else get some benefit. And as you've heard, there's not one size fits all. The right approach depends upon where you are in life and also where you are in your journey. You need the right plan, the right team, the right discipline. And remember, property is a long-term game, and those who succeed are the ones who think ahead, avoid the mistakes, and build a portfolio that becomes a cash machine in the future. Brett, thank you very much. Look forward to catching up with you again next week to have another chat.
Thanks, Michael. Always good to talk.
If you'd like to win a hard copy of one of my books, this week I'm giving away Michael Yardney's Guide to Investing. Enter this week's Property Trivia Quiz. Go to propertytrivia.com.au. I'll leave a link in the show notes and enter the answer to the question I'm about to ask. And don't worry if you're listening to a slightly older episode, your entry will still count and everyone gets a free property report. My question for today's show is, which Australian territory doesn't charge land tax? A lot of people didn't even know that's the case. Which Australian territory doesn't charge land tax? Go to propertytrivia.com.au. And by the way, in the show notes, there's also a link to podcastbonus.com.au, where I've got a range of extra bonuses, reports, my way of saying thank you for listening, podcastbonus.com.au. Well, I trust my chat with Brett a couple of moments ago gave you some good insights into what you should do, whatever stage of your property investment journey you're at. But despite where you are, the market's moving on. It's not wondering or waiting about you. We know there have been interest rate cuts this year. We know there's going to be more to come this year and next year. We know that buyers are entering the market and competition's heating up and prices are rising. Of course, smart investors aren't waiting for the headlines to explain all this. They're already making their move. And at Metropole, we've helped clients through multiple property cycles. We know where to take advantage of this stage of the cycle. By the way, we also know what areas to avoid. So right now, our clients are positioning themselves to secure quality properties, while some others are still waiting on the sidelines. But my suggestion to you is you have a complimentary wealth discovery chat with one of our experienced wealth strategists at Metropole. Go to metropole.com.au. I'll leave a link in the show notes, but just have a chat. Whether you're buying your first home, your first investment, or adding to your portfolio, you're simply just wanting a strategy to make the most of this unique opportunity, because there is still a window of opportunity. Yes, you've missed the bottom of the cycle, but there's still the beginning of what I'm calling a super cycle happening at the moment, a period of prolonged property growth for a couple of years. But not all properties are going to outperform. So allow us to help you build a strategic plan to suit your circumstances. Let us show you where high-performing opportunities are. Let us help you navigate this stage of the property cycle with confidence and clarity, because we're much more than just another buyer's agent. We help our clients safely outperform the markets through strategic property and wealth advice. Go to metropole.com.au. We'd love to be part of your ongoing wealth creation journey. Take advantage of this opportunity.
Now here's Michael's mindset message. Remember, a change in your thinking will lead to a change in your life.
In today's mindset message, I want to share with you one of the biggest lies we've been sold, and that is that success leads to freedom. Look, from a young age, we're taught that if we work hard enough, if we earn enough, if we build enough, if we invest enough, we eventually arrive at that magical place, freedom. But here's an uncomfortable truth. If we're not careful, success can trap us instead of freeing us. Look, I see this all the time. Two traps in particular. The financial trap. You start earning more, you build wealth, you grow your property portfolio, but then your lifestyle grows just as fast. Bigger home, flashier car, more luxurious holidays, and suddenly the life that you built to reward yourself, and you do deserve rewards, but suddenly the life you built to reward yourself requires your peak earnings just to maintain it. The moment your work loses meaning or you crave a change, you're stuck. Walking away isn't just about you anymore. It means unwinding the expectations of your family, of your team, of your social circle. The house you built to showcase success actually becomes a cage. The second trap, so the first one's the financial trap. The second one, I guess I'd call the identity trap. This is a bit subtler. You become known for your success. You're an entrepreneur, a property investor, an expert in your field. But what happens when who you are now doesn't match who you want to become? Tearing down the identity feels like erasing yourself. You fear losing relevance, respect, admiration, so you keep playing the same role long after it stops serving you. Here's a solution, though. I'm going to suggest you build a margin of freedom. The key to avoiding these traps is to create a space around you between your reality and your expectations. That's what I call a margin of freedom. Think of it a bit like a buffer zone in property investing. You don't stretch yourself to your absolute borrowing limit or over-leverage your portfolio because you know markets cycle. That buffer gives you the option when the unexpected happens. And in my mind, it's the same in life. There's a financial margin. Keep your lifestyle well below your means. Let your wealth compound instead of inflating your expenses to match your income. Every time your income goes up, your expenses go up. Have a financial margin. And number 2, have an identity margin. Don't believe your own social media posts. You're not your job title. You're not your net worth or the size of your portfolio. So my suggestion is stay curious. Keep tinkering with new ideas and roles before life forces a change upon you. I guess I call this freedom by design. Freedom isn't about hitting a number in your bank account, owning 10 properties outright, or it's about intentional design. Live below your means, stay grounded in relationships that matter, detach your worth from your work, protect space for play, for reinvention and exploration. Because the real goal isn't just to build wealth, it's to build a life where you're free to choose. Success alone won't give you that, but your margin of freedom will. Thank you for spending the last little while with me. I hope you got some benefit from this show. But before you move on to the next podcast you're going to listen to, let me remind you I have another show that I produce once a week with leading demographer Simon Kirstenmacher. We call that Demographics Decoded, where Simon and I unveil the trends that are going to shape your future. In my mind, this is a must-listen-to podcast for anyone interested in property investment, but also for business people and entrepreneurs. So if you don't currently subscribe to Demographics Decoded, just please stop for a second and subscribe on your podcast app where you're listening to this, or on YouTube. And of course, if you don't subscribe to this show, the Michael Yardney podcast, why not click the link that says follow or subscribe wherever you're listening right now. So twice a week, you're going to get benefit from my guests and me. And I'd like to ask you a little favour, please. If you did enjoy today's show and you know somebody who would also benefit, please tell them about the Michael Yardney podcast and Demographics Decoded. There's a share button on every podcast app. On Apple Podcast, there are 3 little buttons at the top of the player. Or just tell them about it. Just have a chat with them. Now, I hope you're going to be doing them a favour, and you're definitely going to be doing me a favour in my quest to help as many people as possible to become financially literate. And by the way, I've got a special bonus for you as my way of saying thank you for subscribing. Just go to podcastbonus.com.au. There'll be a link in the show notes, podcastbonus.com.au, where I've got a bunch of ebooks and reports. It's just my way of saying thank you for taking the time to listen. And remember, the information that we give you in this podcast is general information, not specific information about your personal circumstances, because we don't know about them. But if you do want specific information, you can always have a chat with my team at Metropole. Go to metropole.com.au. If you really want to learn more, you can always listen to the previous podcast, the many episodes we've already published. Just go back to the old episodes, which each have lessons about property investment, success, and money. Once again, thanks for listening to today's show.
Thanks for listening to this episode of the Michael Yardney podcast, which was brought to you by Metropole, who help their clients grow, protect, and pass on their wealth through strategic property and wealth advice. If you like what you heard and don't already subscribe, you'll find us on iTunes or on your favorite Android app as the Michael Yardney podcast. Watch out for our next show, which comes to you twice a week, and you'll learn some new ideas about property investment, success, and money in around 30 minutes. To get more of Michael's thoughts, go across to www.propertyupdate.com.au and sign up for his daily morning briefing, and you'll hear from not only Michael, but a group of leading property success and money experts. And just a reminder that the information you heard in this show today is general educational advice and not specific investment advice, as we don't know your personal circumstances. If you're looking for specific advice, why not ask the team at Metropole to help you?